Streetlights don't flicker when a great power starts to lose its edge. There's no siren. The first clues are quieter. A port schedule that keeps slipping, a standard you have to license from a small country you used to overlook, a budget that buys less deterrence than it did a few years ago. If you want to see these signals in motion, study the handoff from Spain to the Netherlands. It's a story of how scale can be outmaneuvered by organization, how treasure can be beaten by trust, and how rules and logistics can do what armies cannot. It matters now because today's shifts, in sea lanes, chip-making tools, and trade rules, look a lot like the early symptoms of another rebalancing. The cycle is familiar. Powers rise when they combine productive economies, credible money, and the ability to secure trade routes with institutions others trust. They plateau when debt outruns income, when politics grows brittle, and when rivals master the next set of tools. Shocks, wars, financial crises, sudden blockades speed the turn. Spain to the Netherlands is a clean, early modern example of how this works in practice. An extractive empire that mistook inflows for strength, and a trading republic that turned legal predictability, lower costs, and smarter finance into system-level power. If we read it well, we can see which signals to track now, who keeps the routes open, who sets the standards, and whose contracts the world prefers. Start in the 16th century with the Spanish Habsburgs riding high. Silver and gold from the Americas poured into Seville and beyond, transforming European price levels for decades. The price revolution made goods dearer and wages slower to adjust. Easy treasure hid hard arithmetic, chronic war in Flanders and elsewhere, and a court that spent beyond sustainable income. When revenues fell short or the cost of borrowing surged, Madrid suspended payments more than once in the late 1500s. Each halt rattled confidence, complicated logistics, and forced improvisation in the field. Spain remained formidable, but it increasingly bought time instead of durability. In the north, a different model took shape. The Union of Utrecht in 1579 bound a cluster of provinces into a wartime federation. And by the time independence was recognized in 1648, the Dutch had already constructed the bones of a commercial state. The tools were prosaic but powerful. Canals, warehouses, disciplined information networks, and a legal regime that made contracts predictable. Amsterdam's Bank of Exchange, founded in 1609, stabilized settlement and gave merchants a ledger money they preferred for large transactions. At the same time, Dutch shipwrights built the Fluit, a workhorse cargo ship with a small crew and big belly. It wasn't glamorous, it was cheap, and cheap multiplied. This was compounding in the wild. Lower transport costs widened the range of profitable routes. A trusted bank and improving markets priced risk more finely, pulling in outside capital. Deep capital financed better fleets and storage. Better fleets and storage deepened markets. Meanwhile, the Dutch East India Company introduced transferable shares on a scale that turned Amsterdam into a market town for the world. What Spain attempted to enforce with treasure and garrisons, the Dutch learned to orchestrate with prices, paperwork, and insurance. None of this means the Dutch were angels. Their ships carried spices, timber, grain, sugar, and people under a charter that mixed commerce and coercion. But their system, standard contracts, shared information, enforceable law, did something novel. It made the Dutch hard to replace. Merchants preferred their bills. Insurers trusted their courts. Buyers counted on their schedules. Over time, that network power mattered more than formal claims to territory. Spain's model made the opposite trade-off. Bullion made budgets look bigger, especially when the crown needed cash fast. That masked weak domestic productivity and a costly web of commitments. Inflation ate purchasing power. Creditors demanded higher premiums. War bills climbed. The empire still cast a shadow on maps, but the underlying machine was losing torque. The Dutch didn't defeat it in a single battle. They underpriced it on route after route, deal after deal. If this sounds abstract, put it next to a live dashboard. In 2024 and 2025, the Suez-Red Sea corridor has been volatile enough that major carriers have repeatedly swung their ships around the Cape of Good Hope. In the first quarter of 2025, the Suez Canal Authority reported nearly a 50% drop in transits. Longer routes mean higher fuel costs, more insurance, and delayed cargoes. Ports at the end of those routes feel it in their mix and their margins. Rotterdam, Europe's biggest port, ended 2024 with a slight tonnage decline, and then reported a 4.1% drop in throughput in the first half of 2025, even as container volumes in TEU terms nudged up and bulk segments softened. Those aren't just local headlines, they're the price of security, measured in days, dollars, and foregone options. Security itself is more expensive. World military spending hit a record $2.7 trillion in 2024, the steepest annual rise since the end of the Cold War. That money buys deterrence and capability. It also crowds fiscal space and forces trade-offs, especially in countries with aging populations and higher interest costs. In the 17th century, the Dutch learned that escorts and fortifications were the hidden line items behind a trading empire. The same is true now, only the kit is more complex and the bill's larger. There's a technology rhyme too. In the 1600s, the frontier was organizational. Double-entry bookkeeping, joint stock companies, marine insurance, exchange banks. Today, it's physical tools and code. A single Dutch firm, ASML, makes lithography systems that sit at the heart of advanced chip manufacturing. In late 2024, the company confirmed that updated export controls would add restrictions to metrology, inspection, and related technologies, with compliance timelines staggered into 2025. None of this turns the Netherlands into an empire, but it highlights a durable truth. When a state hosts a chokepoint technology and its laws define who can buy which tools, it exerts leverage out of proportion to its size. Zoom out, and the Spanish-Dutch handoff clarifies how these pieces fit. Rising powers do not just catch up. They find a cost or institutional advantage others haven't scaled, then embed it in rules and habits. They teach the market to prefer their way of doing things. They make rivals pay more for the same outcomes. When the incumbent's finances and politics get heavy, the challenger's lightness is decisive. Now compare the world's main players. The United States still anchors the monetary and tech stack, but it is managing a more contested trade environment and a step up in security costs that filter into everything from shipyards to semiconductors. China remains the most formidable manufacturing system ever assembled and is expanding its edge in batteries, clean energy hardware, and other mid-tech sectors, even as property and local government debt weigh on demand. Europe is rediscovering industrial policy and defense, trying to balance energy transition with competitiveness. In this mix, small tech-leading states, think the Netherlands in chip tools or a handful of countries in sensors and materials, are again punching above their weight by setting standards and gating key inputs. One recent signal on rules bears watching. In April 2025, the World Trade Organization warned that new tariffs and policy uncertainty could push global goods trade into contraction. By mid-year, UN trade agencies were still flagging volatility tied to conflict and policy shifts. That's the modern equivalent of a 17th century convoy decision. What looks like a narrow policy tweak can reroute the world's cargoes, timelines, and investments. In that environment, states that offer reliability, not just size, earn a premium. What rhymes and what doesn't? Three parallels stand out. First, cost discipline beats conquest in the long run. The Floyd's advantage wasn't dramatic speed, it was lower crew and construction costs. Today's equivalents are boring, permitting that cuts months from a substation upgrade, a port digitization effort that squeezes idle time out of a key, a compliance regime that reduces rework. Second, credible money remains an institution before it's a metal or a code base. The Bank of Amsterdam made a ledger trustworthy enough that merchants preferred it. Modern reserve currencies rest on deep markets, neutral courts, and openness. Third, overextension punishes late. Spain's global obligations outran its fiscal capacity. The Dutch later learned similar lessons when multi-front wars and political fragmentation eroded their edge. In 2024 to 2025, the cost of securing routes and the compounding expense of deterrence are back on the balance sheet. The winners will cover those costs with productivity, not just borrowing. Differences matter too. The speed of feedback is new. In the 17th century, bad news traveled by ship. Today, a regulatory notice in The Hague can reprice a semiconductor supply chain in minutes, and a missile attack at sea can ripple through European inventories within the week. Additionally, network concentration is far greater. A small set of upstream toolmakers, cloud providers, and standards bodies shape global production in ways early modern firms never could. Finally, demographic headwinds and climate constraints narrow the room for error. You can't indefinitely paper over structural shortages with credit when your workforce is shrinking and your rivers are running low. So, what should we take from Spain to the Netherlands for the next decade? For policymakers, the lesson is to invest in credibility and throughput. Courts that shorten disputes, regulators who make timelines predictable, and infrastructure that moves electrons, data, and goods with fewer losses. For businesses, redundancy is not waste. It's competitive advantage when routes wobble. Dual sourcing, regional hubs, and inventory buffers look expensive until they're cheaper than missed revenue. For workers in towns, the map is reshuffling. Places tied to ports, railheads, substations, and data centers will likely absorb the next wave of capital expenditures, even if the headline trade numbers bounce. There is an encouraging message here for small and mid-sized countries. The Dutch Republic shows that you win by building systems others rely on. Standards, platforms, and institutions that make your way the default. That doesn't mean avoiding hard power. The 17th century Dutch paid for escorts and fortifications. It means the spear tip is price and trust, not flags on maps. The point of this episode is simple. The Spain to Netherlands transition is a template for how relative advantage moves. Spain's bullion bought reach, but not resilience. Dutch finance, logistics, and law turned small edges into a new center of gravity. Today's disruptions, the Red Sea detours, record defense outlays, tighter technology controls, and more interventionist trade policies, are the kind of stressors that expose which states can keep commerce moving at tolerable cost and on credible terms. Those are the ones that gain share in a great transition. Next time, we'll follow the baton as it passes again, the Netherlands to Britain. How did London learn from Amsterdam's playbook, scale it with coal and steam, and then use a global navy and a deeper capital market to outcompete its mentor? What did the Anglo-Dutch rivalry and the Navigation Acts reveal about the limits of a trading republic? And how did Britain translate legal and financial tools into empire? That's historical cycle number 2, and it holds direct clues for any mid-sized power trying to compete between giants. Before you go, I want to hear from you. Where you live, what are the signals? Are ships arriving later? Are fuel surcharges or insurance fees showing up in product prices? Is a new data center or battery plant reshaping local jobs? Are firms in your city opening second facilities to hedge risk? Share what you're seeing in the comments. Your ground truth helps us map this transition, not in theory, but in the docs, invoices, and paychecks where it's actually happening.